Good morning everyone and welcome back to Morning Markets here at True Potential. My name's Kevin Kidney. It's Thursday the 25th of April and today we're going to focus in on corporate earnings and illustrate to you how this is moving in a positive story along with the global growth story. So colleagues have updated you this week on the continuing global growth story and how that continues to improve. Remarkably, the UK continues to lead the way with leading indicators surprising to the upside for the services-based economy as consumers are increasing their spending plans as real incomes continue to rise here. Very much to the lagged effects from the energy price shock are in the rearview mirror. And this is a story reflected across much of the Western world with energy prices much lower. Consumers are more confident about their spending plans. And this fits neatly with some of the updates we've had from US corporates this week. Two stories in particular are revealing about where we may be in the global corporate profitability cycle. Earlier in the week, we had an update from Tesla. CEO Elon Musk disappointed markets with further declines in both sales and revenue. Now, this has very much been a story over the last 12 to 18 months for Tesla. With increasing competition in the electric vehicle market, Tesla is being crowded out by some of the legacy automakers. So what we've seen is that actually the share price for Tesla rose 10% following this disappointing earnings numbers. But why was that? Well, it's because CEO Musk gave some very interesting guidance for future production intention. The company intends to bring forward some next generation development from 2025 into the second half of this year, such that they were going to be able to lower the unit price for some of their vehicles and improve the software of some of their next generation cars. But importantly, they're going to do that on existing manufacturing lines. So investors were encouraged by the idea that the company might be able to increase sales without having to increase its cost base. And that's why we saw an immediate rise of 10% in the stock price. However, we should contextualize this with the news that the share price had fallen around 45% already since the start of the year. Now, on the other side, Meta had seen its share price rise by almost 45% year to date. But overnight, the company gave some interesting updates which saw the share price drop almost 19% in after hours markets and then settle down around about 16% down. And this is despite the company announcing a near doubling in profitability over the last year and an increase in revenue of 27% since the quarter the year past. But why did the share price drop? And that's because CEO Zuckerberg surprised markets by announcing he intends to increase capital expenditure from an upper target of $37 billion to $40 billion. Now, historically, investors in Facebook haven't taken kindly to surprises to the upside in spending intentions by the company. This happened in early 2022 when, following a similar announcement of increased spending plans, the share price fell 33% in the following 2 weeks. So it's surprising that CEO Zuckerberg took the risk of announcing an increase in spending intentions. But what message can we take from these stock price reactions? It's that corporate profitability continues to be healthy. There is continued investment in the AI space. However, investors are now more focused on margins as much as they are focused on profitability. And what the signal is for C-suites today is that corporates need to focus in on keeping their costs down and increasing their profitability such that margins can expand. So that's what we can take from these tech names. Please join us tomorrow when we'll round up the week for you and we'll focus in on some US GDP numbers. Thank you.